Hello again, everyone. Welcome to the Options Mentor. All right, so we head into Thanksgiving week, which is often a week where there's not that much news, and usually it can be pretty peaceful. Good time for time decay. So shaking us up a little bit this time, though, because on Tuesday we have the Fed minutes from their last uh, announcement coming out 2 weeks ago. So it'll be Tuesday at 2 Eastern. Those minutes will come out. The market would likely react at least some off of that whenever they get to see a little behind the scenes of what the Fed governors are saying in their meeting and who's for what, who's for cutting, who's not. And so that type of thing can be very something that can move the market. And also, then the next day, Wednesday, we got the GDP comes out before the market opens about an hour before. And then also on Wednesday at 10 a.m. Eastern, we also have the PCE. So lots of things coming up for what, like I said, is normally a low volume week. Then we have Thanksgiving on Thursday. Friday is a early close. I think it's like 1 Eastern, I believe, but it's a short session, often very, very low volume. But things can happen in low volume markets. But I expect that most of the fireworks, whatever they will be, if there will be any, will be over probably Wednesday afternoon, I would think. But we'll have to see how that works out. So just a little more action than a Thanksgiving week often would bring us. But I have a trade in mind. I've talked to you guys about it before, the double butterfly. And today I'm going to show you one. And I'm just going to show you different ways that you could consider and do the trade. Um, if you understand all that, just trade these on paper, maybe see which method you like the best. Because there is different things you can do. You can have them different widths. You can have them balanced, unbalanced, however you want to do that. So let's take a look at one here as I share my screen. We'll take a look at a double butterfly that I've set up here just for our initial look in the SPX. So one thing I like to consider, at least think about, have in mind, whatever you want to call it, is I like to see the expected move by the Friday of the week I'm in. So if you want to put this on a Monday, I kind of like to know what do they think this market could do by Friday. And as you can see here, by Friday, they're thinking maybe $65 plus or minus. Now this is about pricing pressure. It's not just someone's opinion. They kind of have a method for calculating this. Very often it will reflect the outer limits of a move, although certainly it can go more and it can also lay there. But it's something to think about. So a lot of times if you look at that, you go, okay, $65 up or down. It's kind of a base marker of how you might want to see what your position would be like if it made that move. So let's take a look over here. Oh, and by the way, I did go out to the 20th of December, which is 26 days out. I did use the PM, the weeklies, whatever you want to call them. Once a month, of course, we do have the AM, expires right at the open. That's kind of your traditional options expiration. Third Friday expires first thing when the market opens. I just have gotten in a habit of just doing the weeklies all the time because sometimes in a trade like a diagonal or calendar, if you mix the AM and PM, you can get kind of a strange looking graph in the analysis screen, which you guys know I love to use. So I just always stick with it, and then you don't have any worries about it at all. It's plenty liquid, so not a problem. So it'll be about a 26 days out trade. I like to be 3 weeks or more because if you come in very short term with flies, not only do they get more expensive, they also around these edges are much worse off. So you have to, that's something I like to think about. So here's one thing I did. So I'm using Friday's close where we closed at 59, basically 70, 59.69. The VIX here around 15, so perfect for flies. And what I did here is I went up 60 or 50 points to 60.20 and put the center of my call fly there. And then I went up 50 points and down 60. So once again, that's up 50 points from where we're trading for the center and then up 50 points from that center and down 60 points from that center for the upper fly. And then on the downside, did something similar. I went down 50 points, and then I went up 50 and down 60. I have to go down one more here. Oh, that's right. I wanted to show you guys this. Never mind. Let's go with this. So what I did with this one, like I said, up 60, down, up 50, down 60 on the call, I did a balance fly here on the put side, where you're up 50, down 50. Now, what does that do for you? Well, it gives you a little better look down here at the bottom. So let's say I did these both the same way with the asymmetrical, and I did the 50 up, which is fine, and then I did 60 down. Now, if I do that, you see what happens over here? At the lower break even, I'm down a couple $100. And if I do the balance fly, 50 up, 50 down on the downside, then you're down about $70. So it gives you, if we happen to go down, it doesn't look quite as bad. Of course, that'll take a little bit off of the upper here. But if you look at the chart, we're going to go over here and look at a chart in SPX. And we can see that the all-time high is 60.17. So in order for us to get in any trouble with this at all, we're going to have to go well past all-time highs. It seems odd to me that we would do that on Thanksgiving week. Could we do that the week after as we head into December? Absolutely. And I just think that it's a little bit less likely to do that as in this type of a week. But we'll have to see. Like I said, we do have an unusual amount of news this week. So with this trade being set up this way, you do have so much room here on the upside. You don't have anything, you wouldn't even think about adjusting this or repairing it until you got at least the 60.50 on the upside, and probably all the way down to like 58.90, which is about 80 points lower on the downside. So it gives you a lot of room. Now, you notice here that there is this, what I call a bite below the zero line. Now, in any kind of trade where you're mixing in a long vega, let's say we do a fly calendar or a double calendar or a double diagonal, you would never want the two complexes to connect to each other below zero because that's really dangerous in a long vega trade. But in a fly like this, watch what happens. Even though ultimately you would lose money if you stayed here in the very center of this trade, you can see on expiration you'd be down money. But along the way, time decay can work for you, and you can actually be up, even though you're in this kind of ultimate dead zone on expiration. But we're not staying till expiration, so that's okay. And so with this trade, I'm comfortable with this. This is probably the maximum that I'd ever want to see a bite below the zero line. You just don't want to take too many chances with it, but you can, with a double fly, do something like this. So another thing to look at here is, what did the trade cost us? Well, the trade, price right now, this is Sunday actually, it's trading at like $13.45 for this call fly, and $4.10, really an inexpensive balance fly. That's, this one's 60 up, or 60 down, 50 up, and this is 50-50. So you're not getting super wide. So these trades can be inexpensive. So if you put this together, what have we got in this? Well, we got a little over about $1,750 in this trade if you got filled around the mid on these. And by the way, when I did this, I would just, if I said, hey, this is what I want, I'd just go out and I would just try to get the mid price here and send this in for the mid price. I don't, mess around a lot with, shopping. Oh, look, the mid price is $4.10. Let's see if I can get $4. That's not going to happen. And if you ever think you've had that happen, it's only because the mid price fluctuated down. So you can't be too choosy or greedy. I think whenever you're getting the mid price anyway, which is already, you're negotiating, because it's certainly not the ask. It's well below the ask whenever you do a mid price. So if you get anywhere around it, even within 10, 15 cents of it, sometimes even 20, I'm fine with it. But I do try to start out at the mid on both and try to get them filled separately. Now, of course, this trade will have to be done as two separate trades. You can't, put on or take off a double fly as a double fly, the maximum amount of legs in a trade is 4 legs. This, of course, would be 6. So you can't do that. So that brings us to another issue that you need to think about when you do this. This trade does have its complications like that. And another thing is the profit. So you guys know I normally like to go for 8 or 10%. Sometimes, on a Friday, particularly if it's before expiration week, I'll actually take a little less than that. So what would we want to get here? This, like I said, it's a $1,750 trade. So, somewhere around $175, $150 in that area. And I would just take this trade off. How would I do that? Once again, when I saw the P&L was, say, at 170, if I get these mid prices, well, I'd lock those mid prices, send them both in at the mid price, and try to work my way out. Now, be aware, there'll probably be some slippage. So if you said, Mark, I really want 170, well, then you probably should wait till you're seeing 190 in your P&L open or something like that. You'll have a better chance of getting out that way. But a lot of times there'll be a little slippage in this. What often happens, if you put in your orders for each of these, maybe you're up 170 bucks, whatever fly it's nearer to. So if we were a little further up here, for example, will usually get filled first. It's easier to get a fly filled that's a little closer to where we're trading. Or if we were down in here, you'd likely see the put fly filled first. And if we're in the middle, hey, who knows? We'll see what happens. In this bull market, I wouldn't be surprised if the call fly gets filled first in a more mid-range graphs position because calls are pretty popular in this market. But just expect that. Expect some slippage if you're going to do this, getting a little less than what you went in at. If that's not going to work, well, then wait till you have a little more profit, and then you have a better chance of getting that. So this is, as I said, one way to do this. Now, as I pointed out earlier, we did do 60 up or 50 up, 60 down on the call side. We could do the same thing on the downside where, as I showed you earlier, you're taking more chances on the downside, but you could get a wider trade. If you did this, you would be 50 up, 60 down. And now, if you do asymmetrical flies with a put, only puts, calendars doesn't matter, but in put butterflies, brokerages, for some unknown reason to me, they go ahead and margin those like you're selling a put vertical and buying a put vertical. So what happens is you get a low debit, but you get margin with that trade. So what's it come out to be? Well, 225 and 1020. So it's about around a $1,250 trade. But the thing is, even if you did it with calls, what do you get? Around the same price. So it's not like the puts are cheaper or the calls are outrageously expensive. Really, they're very similarly priced. It's just that the put asymmetrical will have margin and the call one won't. That's not a big deal. It's just money they hold out that ends up basically about the same amount of money out of your account if you did 2 call flies or you did it this way. That's something to remember whenever you do that. I've had people go, oh, I put on a put fly and the 225 debit, and then maybe they wanted to adjust it later with a call fly, and it was $1,300. They're going, holy cow, I'm not doing that. Why is it, 4 or 5 times the price? Well, it's really not. It's because the calls, all the price is in the debit. With puts, you have a small debit, but you do have that margin. So just keep that in mind. Now, there's nothing wrong at all with doing it this way. Maybe you want a flatter upside. You can see that whenever we have it done this way, with both of them being 50 up, 60 down, if we get to that upper break even, maybe you're a bull and think we're going crazy this week up to the upside. You'd be down about 35 bucks at the upper break even. Now, if you did do this as a 50 up, 50 down on the bottom to balance, and then this, you're down 120 bucks. So you have a little worse upside if you do the symmetrical fly on the bottom, but you have a better downside, not down as much. So let's go back over here and talk a little bit more about this idea. So here we have that 50 up, 60 down, lots more room up here. Now there's other things you could also do. If you wanted more range, it's also going to be more expensive. You could also do something like going 60 up, 70 down. So we'd be at 60.80 because we went 60 up from 60.20, and 70 down would be 59.50. And then on the downside, if you wanted to stay asymmetrical, then we might go 60 up, which would be the 80, 59.80, and then 70 down would be the 58.50. I don't have a problem with that. You can see, look what happened, by the way. It does connect in the center. If we go 60 up, 70 down, and then 60 up, 70 down on the call side. I don't have a problem with it. If you want to do that, it does give you a nicer looking center. You don't have that bite below, but the trade costs more, right? This trade would be 980, about $1,300 put side, and then another 16 and change on the call side. So you'd be close to $3,000 with this trade, and that's all right. You know, if that's your level of comfort and you understand what you're doing and everything. Well, let's take a look at this. We can use any of these to calculate this, but let's see how long we'd be in it. If we did that, we maybe want to get around, I'd probably want to try to get 250, 300 in a trade I had 3 grand in. Let's see how long that takes. As I go forward here, if we just get to Friday, you're up about $100. And what if we get to the following Friday, the 6th? Hey, you'd probably be in a range where you'd want to take this off, maybe even sooner. So the week after next, just based on time decay. Now, this doesn't count anything that volatility may help you or hurt you, or what price movement. As you can see, if you move the price around, things are different, right? As you get further away from the center, the pricing, your profit can be slower. So you just keep that in mind. But if we stayed around here, you might be in this trade maybe a little over a week. So this is something you can think about. I don't get too hung up on how long I'm in a trade. Everybody would love to put on trades and take them off very quickly. But with this style, you need to be patient a lot of times. It'll be rewarding over time. You don't want to take a trade off just because you've been in it a week or that type of thing. You know, whenever you have a trade that's over 3 weeks out, give the thing time. So you may be in this, just expect that. You might be in this trade a little bit longer, but it will have a higher probability of working for you than some trade that's really short term. Short term trades go for and against you quickly, but that against you quickly is something you need to keep in mind. So that's why I like to be a little further out. I'll accept the slower time decay to be able to have a trade that's more stable, and maybe I won't even have to adjust or repair it. So that's just my perspective on that. Um, and like I said, you could do this, 60 down, 50 up, or you can do the wider. You can have asymmetrical on one side and symmetrical on the other. Let's look at that. What if we did this 60 up, 70 down on the call side, and maybe do 60-60 on the downside? Let's just see what that would look like. Looks great. Doesn't look as pretty up here, remember? If we do a balanced put fly, it's better on the bottom. So if you're really worried about a down move, this could be the trade for you. And on the upside, though, expect a little more pain as you get near your upper break even. Now, this trade would be, there's no margin on a symmetrical put fly. You just have the debit. So this would be a trade, what is that, about a $2,200 or so trade? Just quick math, eyeballing it. How long would we be in it to get maybe $200 or so? Let's see. You might be in this trade. Well, you'd have about 100 of it by Friday, and maybe by the middle of the following week have your 200. So what I wanted you guys to get out of this, of course, is to learn a little more about double butterflies, the ideas, the concept about you can have a bite, a dip below zero where the two flies connect in the center. That's another thing I really wanted you guys to understand about this. And also what wing widths do for you. And the fact that, hey, am I symmetrical? Am I asymmetrical with the butterfly? Those are all different concepts. It takes a lot of time to really develop your skills in this style of option trading. I often tell people that I'm mentoring, if you're dedicated and you really work at this, you have to be reasonable and really to be solid in all these strategies. It could easily be a year, it could be less. That doesn't mean you're not making money for a year. But what I'm saying is for you to have good consistency in your trading and really be knowledgeable and comfortable, probably about a year, whenever the market really kicks up and goes crazy, having the confidence that you know how to deal with something is very important. The more experience you have, the better that will be. Now, another thing about that is of course you need to know repair strategies. As I tell you guys, I teach those over at aramer.com in my Traders Lounge opening bell, and then a little more intensely in the Traders Lounge than in the opening bell. We usually go through a little more live trades there. The opening bell I do every market day right before the market opens, 30 minutes. Just kind of go over what happened overnight, what trades look like they'll be in focus that day, and then maybe midday, whenever we have a Traders Lounge a couple days a week, I'll start looking actually live at what looks good at that point. So that is one thing that you really get by being in that. And then, of course, another one to help you learn, if you just want to follow me on trades just for education, I have a trade alert service also where you can follow along with me. With that, what I do is if I'm going to do a trade like this, I set it up here for myself. I go and I send out an alert, tell you guys what I'm going to do before I ever place an order. I'm not front running you. Then after I send out that alert, I go ahead and place my orders. Then I let you know what I get filled at. Sometimes you can have a little different fill than me, but it can still be fine. And then if I ever take the trade off, of course, let you know before I do it. If I'm ever going to maybe I'm going to set an order in for a single complex, like a calendar or a fly. It's a single complex. You can set an order to close it at your profit point. I'll let you know what that is and what I'm setting it at. And then if I ever have to repair it, I'll let you know, hey, here's my adjustment. And then, of course, any of these, I'll let you know what my fill is afterwards. And always I put these alerts out before I trade the things myself. It's a great education, I think, to follow along with those on paper. If you get confident, do what you want to do. But those trades will be in SPX. I might occasionally do a SPY, but I do my trades mainly in SPX in that alert service. I try to keep them small in that alert service. If people get confident or experience, want to do them bigger, help yourself, whatever's right for you. But I do them, I show them small. Maybe I might even do this size right here, if you were in my alert service, because I normally try to keep trades starting out somewhere between 2,000 and 4,000 bucks will be the starting point, and many times that's all you'll ever end up needing in the trade. So that's a little more about what I do every day. If you're interested in that, just go to the description of this video. You can see the links on how to come to my Traders Lounge help desk, or you can also see how to get with my trade alert service. You can bundle those all together at a great price and get the whole thing. And of course, I always offer one-on-one mentoring. If you want to know more about that, just contact me directly at that address there in the description. It's the Options Mentor SPX at gmail.com, but the email address is there. You can always email me questions there. You can also email me there. I'll tell you how mentoring works. It's just you and I in a Zoom meeting room, one-on-one, and I'll walk through how the cost and how that works with you and scheduling, that type of thing, if you want to email me about it. And as always, just here on YouTube, I appreciate it if you would subscribe and tell your friends. Hit the like button, hit that notify button so you know when I've put out a new video, and follow along with me here at YouTube every week. Here on the YouTube channel, my whole idea is to get you maybe to taste the cooking, so to speak, see what I'm about, see the kind of trades I do. When you want to drill in, get more efficient, then join me over at aramer.com. So that's what I have for today, folks. I really do appreciate you guys being here. Please check out the links in the description, see what you think of that. And I will be back here next week with another video talking about what I think might be going on the following week. So have a good one, folks. Good luck in all your trades, and have a wonderful Thanksgiving or a market day off if you're not in a country that's celebrating it this time. Have a great week, and I will talk to you soon. Have a good one. Bye-bye.